Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister, you'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, an IROC dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss how to review your will to ensure it aligns with your intended outcomes. Specifically, we're going to discuss potential issues that can arise with an estate, 3 scenarios I have come across in the last 12 months, considerations you should discuss with your legal counsel, who should be reviewing their will, and lastly, as always, a few action items for you to consider. Well, first off, I gotta hit you with the disclaimer. I am not a lawyer. I am a certified financial planner who has reviewed hundreds of wills as a part of the value I provide my clients. Oftentimes, I do find discrepancies between clients' intended estate goals and what would actually take place if they were to pass. Once we unearth these inconsistencies, legal counsel gets involved to help correct or clarify any potential issues. Second, not all lawyers understand personal finances. So to assume that everything is in good order with your will and estate just because you went to a lawyer may not be wise. This may leave your beneficiaries exposed to unfair distributions that can cause conflict, excess tax payable by your estate, and a potential tax liability to your executor, and more. Now, obviously, I'm not speaking for every lawyer out there. Many lawyers, especially those I've met with who specialize in estates, are very well in tune with how personal finances need to be considered when structuring a will. That said, over the last year or so, I have reviewed 12 wills for prospective and new clients and have found some inconsistencies in a few cases. These are families who would have seen their executor exposed to potential liability, unequal distributions to beneficiaries, potential loss of government benefits to disabled dependents, and an early distribution of a large estate to minor beneficiaries. So today, let's walk through 3 scenarios I came across and then equip you with a few questions to ensure your estate plans are in good order. The first scenario involves a potential tax liability to an executor. In this case, the will stated that everything was to be split up 3 ways between 3 adult children, one of them being the executor of the will. This individual had a condo as a primary residence worth around $400,000, a RIF account with $1.2 million, and a TFSA with $300,000. Due to her late husband's passing, all the registered accounts were now solely in her name. All in all, an estate valued around $1.9 million. In this scenario, the RIF and TFSA accounts named the 3 adult children as direct beneficiaries. So at her passing, the full amount would bypass the estate and go straight to the kids. Then the primary residence would be split 3 ways, with the likelihood that after the probate process, the house would be sold and the proceeds dispersed to the kids. So, sounds pretty good so far, but when we started to look at the tax implications to this decision, things looked a little bit different. First issue, the total tax liability payable by the estate was around $550,000. Now, while the home qualifies as a primary residence, so there would be no gains tax, it would flow through the estate. The TFSA and RIF would be directly distributed to the beneficiaries. And while the TFSA is never taxable, the RIF account is still 100% taxable to the estate. even if it passed directly to the beneficiaries. So, this $1.2 million RIF account would attract around a 50% marginal tax rate, regardless of the province you reside. So, even if the $400,000 condo was sold, net of realtor fees and transaction fees, the executor would still be liable to pay the balance still owing by the estate, which in this case would be approximately $200,000 in taxes still owed. The executor, who was also one of the beneficiaries, would need to go back to their siblings and ask for the money that they received directly as inheritance to pay the outstanding tax liability of the estate, which for some families might be okay, and for others this could be a serious issue. So, to help address this issue, one option would be to name the estate as the beneficiary on the RIF account rather than the 3 adult children. They would still receive the TFSA directly, so no change there. But now both the RIF and condo would go through probate, taxes paid, and then the estate settled, without a need for the executor to go back to the beneficiaries and ask for money to pay the taxes. Now, granted, the RIF account is now subject to probate, which in some provinces is a fixed rate, while others it is a percentage. So, for example, in Alberta, this potential estate restructure would have an approximate probate cost with a flat fee to a maximum of $525. While if this took place in Ontario, the probate would be around $24,000. So a significant discrepancy depending on where the estate is settled. That said, in the scenario I just went through, is it worth paying the probate fee to ensure taxes are paid? Or will the executor take the risk of being liable for unpaid taxes in the estate? The next scenario I came across recently was an unintentional, unequal distribution of the estate to the beneficiaries. In this case, the individual who had the will believed that their estate was going to be split equally amongst their adult children. But after reviewing the will, it was stated that one child would receive a fixed amount, while the other two would receive the balance 50-50. When I ran the numbers and showed the results if the client were to pass away today, he was pretty shocked. The one child would receive a fixed amount of around $100,000, while the other two beneficiaries would receive approximately $500,000 each after all taxes, fees, and probate was paid. However this wording got into the will is neither here nor there at this point. What's important is that we caught it and corrected it with legal counsel. The third scenario is a potential issue naming minors, whether it be children or grandchildren, as beneficiaries in the will. A common structure I come across will have the estate assets held in trust for the minor until they reach age 18, and at that point, the now adult child or grandchild would inherit their share of the estate. In a recent case I came across, the minor children would have inherited around $2 million each in today's dollars at the age of 18. Now, one potential fix for this kind of lump sum disbursement at a young age would be to add specific wording to the will. This could be a staggered disbursement based on their age, or naming specific milestones where money would be released. Now, this does, however, add complexity to the will and trust arrangement, and would require administration on a go-forward basis, at a cost until the funds were fully dispersed. So while some may be okay with a full disbursement when a minor becomes an adult, others may want to add safeguards, as I mentioned, to help protect the beneficiary from potentially poor financial decisions at a young age. At the end of the day, if you haven't updated your will in over 5 years, or you've had a serious event like a business sale or marriage, it would be wise to have a look over things to ensure everything is still in good order. This is where having a team of professionals like a lawyer, accountant, and certified financial planner can all work together to ensure your will, investment accounts, assets, and more all align with your intended wishes. Okay, so that will do it for today. Here are your action items for today's episode. First off, who are the beneficiaries of your registered accounts? If you're married or in a common law relationship, it's likely your spouse. However, if you are widowed or singled, remember that these beneficiaries will receive the money directly, which may still have a tax liability attached, payable by the estate. Lastly, as I just mentioned, be sure to dust off your will and give it a read, or bring it to your lawyer or other trusted professional to get a second opinion. A quick review or discussion could make a world of difference to your heirs. Alright, so that'll do it for today's episode. Be sure to add us on all of our socials, LinkedIn and Facebook. Be sure to sign up for our Retiring Canada newsletter. And you know what? Hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.